Is it a buying opportunity for U.S. equities, or should you be focused elsewhere? We're here with two sides of that debate. Joining us now is Jeff Saut of Saut Strategy and Lisa Erickson of U.S. Bank Wealth Management. Jeff, all year long, we've been hearing the U.S. is the best best house in a bad neighborhood, and you should stick in the U.S. because we have better growth and we have higher yields and we don't have an energy crisis to the extent of Europe. Is that still the case, though?
Yeah, I think that's still the case. Secular bull markets tend to last 15 to 20 years. Do you get pullbacks? Yes. We've had at least a dozen 10% plus pullbacks this year. And every time we get a pullback, the bear boos come out of the woodwork and tell us we're in a bear market. And it's just not so. Bull markets tend to extend for 15 to 20 years, and we're in a secular bull market.
Wait a second. We are in a bear market, though. We're 20% off the highs for the S&P. Isn't that it's technical definition? It's felt like that for a lot of investors.
That still doesn't mean you're not in a secular bull market. If you go back and study 100 years of the Dow Jones Industrial Average and look at secular bull markets, you'll see 20 and 30% pullbacks, and yet you were still in a secular bull market.
Okay, Lisa, what's your take?
We're really more cautious, as you pointed out, and really the reason why is while, again, there are some positives to U.S. stocks in terms of companies really being able to maintain growth relatively well, even in a tough environment. Overall, we still see a lot of headwinds for U.S. equities, and chief among them really is inflation pressures, which is then causing the Fed really to be quite resolute in tightening its policy, whether it's through where interest rates are headed, as well as with the quantitative tightening program that's going on. So in that kind of environment, we just see it very difficult for stocks to continue to maintain positive momentum. And in addition to that, when you do look at the growth characteristics, whether it's either on a macro basis or what is actually happening in terms of underlying corporate earnings, what you see again is while some are still in, again, that positive territory, they are decelerating. So we are seeing that negative momentum in terms of the underlying operations as well.
Yeah, I mean, I didn't bring up Huntsman, the chemical company, just the latest today. They cut their EBITDA guidance by 20%. Talked about all sorts of weakness in end demand markets, polyurethanes and performance products. So, but the problem, Lisa, is that everybody in the world, if the concern is that the Fed has to tighten and weaken demand and to fight inflation, isn't that happening all over the globe and in places that don't have as strong of a base as the U.S.?
Absolutely. So when you're looking within U.S. equities, again, certainly U.S. equities still relative to other equities do have some momentum and some advantages. But when we're looking at overall how to position the portfolio, our best advice to clients at this point really is to head towards asset classes that have a higher component of ongoing income and yield. And so those would be areas like high quality fixed income as well as global infrastructure. And when you just have a tougher economic environment where there is quite a bit of volatility in prices, again, these types of areas where you get more of an ongoing cash flow stream from diversified sources can be fairly appealing for the portfolio.
Jeff, are you worried about some of the corporate earnings and margins starting to buckle here amid some of these warnings we've been getting from industrial companies, chemical companies, FedEx today?
Yeah, I think estimates are going to come down. I don't think they're going to come down a great deal. Margins have been wide. I think they'll probably narrow a little bit, but not enough to cut off the strong earnings stream we've had. And again, I think pullbacks are for buying in secular bull markets. And I think she makes a good case. But I've been in this business 54 years, and I've been looking at equity markets for over 60 years. And I've seen secular bull markets before, and that's what we're in. And it's probably got another 5 to 7 years to play out.